Hi guys, welcome to Money Theory. In today's video, we're going to talk about technical analysis. This video is sponsored by our Patreon members. If you'd like to support our channel, you can join our Patreon, link in the description below. It's also abbreviated as TA, and it focuses on the price trends. There's lots of different patterns, signals, and indicators. And it's important to remember that it's not perfect. A common phrase is that it works until it doesn't. So don't use it as a guarantee for the price predictions. Just use it as a way to identify better price points to buy or sell. Now let's compare technical versus value analysis. TA is a different philosophy from value analysis, which is also called VA or fundamentals. VA focuses on the business financials, and diehards of one philosophy will think the other approach is useless, but it's important to use both together. VA is to find what to buy and sell, and TA is to find when to buy or sell. Also with TA, remember to not overdo it. You can probably overanalyze and find a pattern that doesn't exist. So the overall goal is to identify when the stock is in an uptrend or downtrend. If you're a swing trader, you would be buying low and selling high, and if you're a long-term investor, you would buy low, hold, and buy more when it's also low again. It's important to ignore the noise. Noise and randomness are more prevalent in shorter term periods like days and weeks, and that's why it makes day trading very difficult. But the noise and randomness is less prevalent in longer term trends like months and years. So by focusing on long-term trend, the TA can give useful insights. And here's an example on the S&P 500. You can see on the top left that there is the day trend, and it's kind of hard to predict what's going on, where it's going to be at any point in time. On the top right, it's year to date. So over a 1 year period, you can kind of see that there is an upward trend. There is some ebb and flow fluctuating. And on the bottom middle, you can see the all-time. This is from the 1990s until now. And you can see that there is a general, more consistent upward trend with some peaks and valleys. A general statistics principle is the law of large numbers. As the sample size grows, the mean gets closer to the average. So you can see in the chart below, in the beginning, there is randomness. From randomly tossing the coins, you can see that it's kind of hard to predict whether it's going to be heads or tails. But as you increase the number of coin tosses, it trends towards the predicted value of 50%. So when we tie that back into stock market, with stocks, a longer time frame reduces the randomness. Also, be prepared to be wrong. The analysis, whether it's both TA or VA, it can help, but it's not a guarantee. So it's important to use risk management. One approach is to limit your position size, like limiting 10% of your whole portfolio into one stock. That way you don't put all your eggs in one basket. And another important principle is to have an exit plan. One method is to set a stop loss, which can automate your exits, but that may trigger prematurely from just volatility. You can also just manually exit depending on your predetermined price. A main principle is reversion to the mean. You can see in the chart on the right that there is a black line, and then the stock price in pink will fluctuate around it. So when the stock is below the black line, it is likely to go bouncing back up. And then when it's above the black line, it's likely to go down. So let's get started on the technicals. The first one is the trend lines with support and resistance. The lines can be upward, downward, or flat. You can see on the chart on the right, in this case, we're drawing two lines, the resistance on the top and the support on the bottom. The support line on the bottom is the relative low price of the stock, which you can buy. And then the top line for the resistance is the high of the price, and that's when you would want to sell. The next strategy is called RSI, which stands for Relative Strength Indicator. It measures the momentum, and you can see it on the bottom. The stock price is on the top and the RSI is on the bottom. So you can see that there is two sections. Over 70% is overbought and below 30% is oversold. So when the stock is above 70, it's considered too greedy and too much people buying, and that it's likely to go back down. Whereas when it is oversold, it means like there's too much fear in the markets and it's likely to go back up. And this is applying the principle of reversion to the mean. But you can also see that it's still not a guaranteed indicator. You can see in June, the RSI bounced above 70, but the stock price continued to increase. So if you sold at that time, you would have missed out on further gains. Another strategy is moving average. And you can see that there is a blue line. In this case, it is a 50-day moving average. So the price will fluctuate above the line and below the line. The most common ones that people use are the 50-day and 200-day. So like trend lines, it creates a support or resistance. And in the image you can see that the stock is above the line. It will likely go back down. And when the stock price is below the line, it's likely to bounce back up around it. So it functions as a way to identify the longer term trends. But what I don't like about it is that it's a lagging indicator because the move had already happened. So if you think that it is in a downtrend and you're waiting for that, it's likely that the stock had already dropped a lot already. So let's tie back into general principles of investing. The first one is don't catch a falling knife. If we look at the AMC stock, if you are looking at the price in August, it looks like it dropped 82%, and you're thinking, well, it can't go any further. If that happened, we'd have lost a further 80%. So you want to emphasize that the company must have value. You don't necessarily need to deeply dive into the financials, but just practice healthy skepticism. Avoid following the hype and the herd, and just have a practical evaluation of the business. Like if the product or service that they're offering is popular. Don't just buy it because it's going to be the future or that people are just saying that it's going to be a short squeeze. So here is an actual filing from the AMC company. It says that we caution you against investing in our stock unless you're prepared to risk losing all or a substantial portion of your investing. Hi guys, hope you enjoyed our video. If you'd like to support our channel, you can join our Patreon or buy me a coffee. Be sure to like, comment, and subscribe. We also completed our financial coaching and business consulting website. Please check it out at moneytheory.net.